Good morning. Welcome to the November 9th edition of Advisory Live, powered by Nasdaq IR Insight. I'm your host, Will Briganti, and joining me today from Nasdaq Advisory Services is Masood Ghazi. Masood, thanks for being back on the program.
How's it going, Will?
It's going well. Good to have you back. For all of our viewers, Masood is a senior analyst with Nasdaq Advisory Services, and today we're going to talk about sort of two kind of major topics, kind of taking some business headlines recently: U.S. Treasuries, as well as the GOP tax bill. We're starting to see the yield curve flattening. Masood, let's begin with articulating what the yield curve is for our viewers.
Yeah, sure. So the yield curve, in very simple terms, is a graphical representation of bonds that have similar credit qualities but different maturities.
Right.
The most frequently reported yield curve is that of the U.S. Treasuries. So it's essentially mapping the 2-year, 5-year, 10-year, and 30-year U.S. notes and bonds on a single graph with maturity on one axis and yield on the other axis. The graph is used typically as a benchmark for other bonds and also has predictive power in a sense that it gives insight as to where inflation and growth prospects are going in the U.S. economy. And the most frequently sort of reported yield curve differential is a difference between the 30-year and the 2-year. The short end, the 2-year, represents interest rates and where that is going,
right,
and the 30-year represents growth and inflation. So when we're talking about the yield curve flattening, essentially in very simple terms, 30-year yields are coming down and 2-year yields are going up.
Okay. Now we're seeing the U.S. yield curve, so the difference between the gap between the 2 and 10-year is now at its flattest since 2007, so in over a decade. What's driving this?
Yeah, so again, as I mentioned earlier, historically, the Treasury yield curve has had quite a significant predictive power. When the yield curve inverts, essentially when short-term interest rates are higher than long-term interest rates, then that means recession is looming. And now when with post-Trump election, we saw the yield curve steepen quite aggressively. But since the yield curve has been flattening, the reason on the short end why the yield curve is the short end, or why yields are going up, is because interest rates are moving up. The Fed is hiking interest rates.
Right.
The Fed is trimming balance sheets. The ECB is toying with the idea of ending QE. Whereas on the long end, there's some skepticism with respect to growth prospects. And inflation, as it's commonly understood, the CPI, has not picked up. So in a nutshell, essentially we're seeing interest rates rise and growth prospects, murky growth prospects with respect to expectations.
So while all of this is happening, the markets are still hitting new highs. So what does that mean?
Yeah, so it's interesting because there's a clear dichotomy between what the equity markets are telling us and what the bond markets are telling us. Equity markets are pricing in a very strong growth narrative. They're trading at 18 times PE, over and above its historical average. Whereas the bond market is pricing in a little bit more skepticism, especially with the tax bill, a pretty significant bill that is currently working through both chambers of Congress. The idea is investors are skeptic about the fact that it may either be watered down or may not pass, especially on the heels of Obamacare, the repeal, replace, whatever you want to call it. The GOP was not able to pass that. So so investors are skeptical whether the tax bill will pass, or even if it does pass, whether it'll be watered down. If it's watered down, then growth prospects won't be as aggressive as it was previously thought.
Sure. Switching gears a little bit, so internationally, over in Japan, we're seeing that the Nikkei is now at highs last seen in the 1990s. Isn't that right?
Yeah, so again, to your point, globally, markets are going up. Last night, we saw the MSCI Asia Pacific Index hit new highs last seen since 2007. U.S. equity markets, as everyone's talking about, has been hitting new highs nonstop, almost on a daily basis. Again, market PE at 18 times, slightly overvalued. And in terms of earnings, we're seeing growth of about 8% over Q3 2016. Q2 also saw some strong growth, and Q1 saw some solid growth also. So what this all means is, again, to our earlier point, equity markets are pricing in huge growth narrative, and it's also helped by very loose monetary policy, whereas the bond markets are flashing some red signs.
Terrific. Well, I appreciate that insight on the sort of global economic landscape.
Absolutely.
Now, before we wrap up, any parting words?
Yeah, Frederick Hayek, a Nobel Prize winning economist, used to state that if you want to understand what goes on in the world, follow prices. So it remains to be seen policies coming out from Washington, how that impacts, one, obviously the Treasury yield curve, how that impacts markets, bonds, not just domestically, but internationally. And obviously with Federal Reserve and ECB policy also.
Terrific. Well, Masoud Ghazi, we'll leave it there.
Thank you
very much. Ladies and gentlemen, this was Masoud Ghazi, Senior Analyst with Nasdaq Advisory Services. For more information about Nasdaq Advisory Services, be sure to visit our website at business.nasdaq.com. We will see you back here next week on Tuesday, where we're going to discuss the real estate investment trust sector with Michael Spector. Thank you so much. Have a great weekend.